Hi, this is Gina Corso. I'm a real estate agent with the Erica and Tiffany Group of Compass in Calabasas. I'm here with my amazing lender, my preferred lender, Paul Cawthorn. He's with Homebridge Financial. He's been in the mortgage lending industry for 16 years. He started in 2003. And today we're going to talk about down payment, which is, I think, scares everyone off. Living here in LA, it's like the rents are super high. And so people feel like they can afford a home, they can afford a mortgage payment, but the big hurdle is down payments, right? So wanted to kind of demystify this subject and get some information from Paul. So Paul, can you talk to, because I think the misperception is that you have to have like 20, 30% down just to get your foot in the door with your first property. And last month or month or two ago, we helped a young couple in Valley Village buy an awesome condo, and they had like $10,000 for their down payment.
Right.
So can you talk a little bit about that?
First of all, I would say I agree completely. I talk to so many people who think that they just won't be able to get it done because they don't have $100,000 for down payment, just a number. But reduced down payment loans. The first thing that you want to know when you have a reduced down payment is that you will have mortgage insurance attached to your loan. So kind of need to take a step back. There is, and the rule for mortgage insurance is if your loan exceeds 80% of the home's value, you will have mortgage insurance. If you're borrowing 85%, 90% of the value of the home, you will have mortgage insurance attached to the loan.
Okay, got it.
Mortgage insurance is paid by the borrower, but it insures the lender against the borrower's default. So a lot of people, have a negative viewpoint of that because you're not even insuring yourself.
Right.
There are two types of mortgage insurance. There is private mortgage insurance, what we call PMI, and then there's government mortgage insurance, which is available on an FHA loan.
Okay.
And what I had been saying previously was that people tend to have a negative view of mortgage insurance because they're paying to insure the lender. So one way that you can avoid mortgage insurance is by taking an 80-10-10 transaction. Where you
what
have,
is that? Can you go into that a little bit more?
Yeah, you would have an 80% first mortgage, and because the mortgage did not exceed 80% of the home's value, you would not have mortgage insurance.
Okay, so it's a little way around.
It's a way of having a reduced down payment of 10% and avoiding mortgage insurance. An 80% first mortgage, a 10% second mortgage, and a 10% down payment. If you need to get your down payment below 10%, then you have to go with either PMI or FHA, government mortgage insurance. Okay.
So how much is needed for a typical down payment?
Kind of depends on the loan amount. Okay. If the loan amount is $484,000 or less, you can do a PMI loan with 3% down payment.
Perfect. Okay.
If the loan amount goes up to $726,000, you have to have 5% down to do PMI.
Got it.
On an FHA loan, the maximum loan is $726,525, same as a PMI loan. But what we haven't gotten into yet is the fact that PMI for borrowers with high credit scores is much less expensive than an FHA loan.
Okay. Paul, let's talk about why would someone choose a PMI loan versus an FHA loan?
Right, perfect. Okay, so PMI versus FHA.
Okay.
Borrowers who have high credit scores will save thousands of dollars taking a PMI loan versus a government FHA loan.
Okay.
Why? Because the mortgage insurance costs on the FHA loan are more than double what the private mortgage insurance costs are on a PMI loan.
Got it.
Okay. But that's for borrowers who have 760 credit scores and higher.
Okay.
If the borrower has a credit score in the 600s, the opposite is then true. The mortgage insurance costs on an FHA loan are half what you would pay on a PMI loan.
Got it. So it's very dependent on their credit score.
Correct. PMI is super sensitive to a borrower's credit score. Okay.
Got it.
If a borrower has a 760 credit score, the PMI costs, will literally be half what, or even more than half what an FHA loan is.
Wow.
But at a 640 score, all of a sudden that PMI deal balloons to double what the FHA mortgage insurance costs are. So that's why when you're having a conversation with a borrower, going back to pre-approval, this is another reason why you need a pre-approval, so you'll know what type of loan program works best for you.
Got it.
Okay.
So why don't we walk through an example of a $700,000 purchase price, PMI versus FHA?
Okay, perfect. So what I always do when I'm talking to someone is kind of ask them for a sense. What sense do you have of what your credit score is?
Okay.
If people say, "Oh, my credit score is really great," then I will focus more on the PMI, right?
Okay.
And then give them an idea of what the FHA is. But for purposes of this, someone may think, "Oh, well, no, I know my credit score is 640. They're going to need to know what an FHA is, right?"
Got it.
So first of all, on a $700,000 purchase, if you're going with a PMI loan, you'll have a minimum down payment of 5%.
Okay.
5% of 700,000 is 35,000. Okay.
Wait, so you can get into a house, $700,000 with 35,000 down.
Correct.
Awesome. Okay.
Awesome. And on the FHA side, the minimum down payment is 3.5%.
Okay.
3.5% of 700,000 is 24,500.
Even better.
Yeah.
Yeah.
So, however, when you look at the mortgage insurance costs,
Right.
you begin to see if you have a high credit score, even though you need a higher down payment with that 5%, it behooves you to get there.
Got it.
And as an aside, either of these loan programs, PMI or FHA, you can use gift funds from family members to boost your own savings to get you where you need to be. Okay?
And how do you accept a gift fund? What are the rules associated with getting a gift fund?
Gift funds must come from a family member.
Okay.
The family member cannot give cash to the borrower, meaning literally mattress money or wads of cash.
Right.
The money
like they have to transfer it from a bank.
Correct.
To the borrower's
The
bank.
gift donor must sign a gift letter indicating that the gift is not subject to repayment.
Okay.
And they must prove their ability to give the gift, meaning they'll show that the money was transferred from their account either to escrow for the purchase or to the borrower's account.
Got it. So it's super important if you are getting gift funds to have a very well-defined paper trail, is what you're saying.
Absolutely.
And to do everything via bank transfer, ACH, wire, something like that.
And to have a well-defined relationship with the gift donor. It cannot
Absolutely.
simply be anybody.
Okay.
And then going back to the $700,000 scenario we're looking at, we were talking about 5% of 700,000 is 35,000. 3.5% down payment on FHA is only 24,500, right?
Right.
But the costs are different.
Okay.
So just to give you an idea, and I should say as an aside that these are estimates, these numbers that we're going to be discussing.
Absolutely.
They give you a good idea of what to expect, but they are subject to change.
Absolutely.
Okay? Specifically interest rates. Interest rates change daily. Okay.
Yes.
So on the PMI loan, 35,000 down payment, the loan amount would then be 665,000. You'd be looking at a mortgage payment of $3,370. You'd be looking at a monthly mortgage insurance payment of $210.
Okay.
Property taxes on a $700,000 property are $729 a month. And then you would have hazard insurance, which I'd estimate at $93 a month. That seems like a random number, but using a factor that typically applies it from experience, that's what you can expect roughly.
Okay.
That total monthly housing cost is then $4,402. Again, that's an estimate. That's a good rough estimate, but that is a rough estimate. You have $100 or so plus or minus on that, depending on what rates do. Okay. And then on the FHA loan, that mortgage insurance payment, instead of $210 on the PMI, if all these payments are relatively the same, the mortgage payment will be a little bit higher on the FHA loan because you're borrowing a little more.
Right.
But it's similar.
Sure.
Property taxes and hazard insurance costs are the same on both loans.
Okay.
It's the mortgage insurance that's much different. On the FHA loan, the mortgage insurance payment monthly is $478.
Got it.
That's versus the $210 figure on the PMI loan. So you get right away, you can see that if you qualify for that PMI with the higher credit, it's harder to qualify for a PMI loan than for an FHA loan.
Right.
But if you can, you will, because you will pay. This is more than double. The FHA mortgage insurance is more than double.
Got it.
So that said, I don't like to give the idea that an FHA is a bad loan.
Sure.
If a 640 credit score borrower is looking at this $700,000 PMI, the mortgage insurance cost will far exceed the FHA 478.
Right.
Does that make sense?
Absolutely.
So they're both great loans, but if you can qualify, if your credit score is higher, if your debt is lower, then PMI is the way to go typically.
Got it. So, and I think this goes without saying, but when you're buying a home, your credit's super important. But especially if you're looking at the lower down payment loan options, credit becomes even more important.
Yeah.
Absolutely.
I mean, when you're 20% down and you're not FHA. You would never take an FHA loan if you're 20% down because it has mortgage insurance attached to it. Regardless of your down payment.
Got it.
So even with 20% down, your interest rate is very sensitive to your credit score.
Right.
But on the PMI loan, it's doubly sensitive because the PMI, the amount of mortgage insurance you pay, is dependent on your credit score. It's also dependent on the amount you borrow, but the factors that calculate the mortgage insurance amounts are doubling and tripling if your credit score goes from 760 to 640, 620.
Right.
Okay?
And we've talked about this before, but this is another great reason why you want to get pre-approved before you go shopping. So look, if I can increase my credit score by X amount, then I can qualify for a PMI as opposed to an FHA.
I mean, that's such an excellent and critical point. A borrower needs to know which loan option is going to work for them and what the numbers look like.
Yeah.
And until you've done a pre-approval, you cannot know with certainty which of these options you would take.
Right.
And you also want a lender who's obviously going to present you with the PMI option and not just say, well, here's an FHA loan since you have a reduced down payment, which a lot of the big banks do.
Got it.
Okay?
Got it. Well, I think that's really great information for people who are looking to buy their first home. People who might not have the full 20%, but they want to get out of renting, throwing away their money at rent. Especially, it's so frustrating when you can afford the mortgage payment. And we have this misconception about how much we have to have down. So knowing all your options, getting pre-approved early, knowing that you need to have a great credit score, improve your credit score to have a cheaper loan option is really important. And meeting with a mortgage lender has got to be your first stop after your realtor, of course. Thank you, Paul, so much for coming out. Again, this is Paul Cawthorn with Homebridge Financial. My name is Gina Corso. I'm with Compass, and thank you so much for tuning in.